So it's Jesse and I's goal to accumulate as many rental properties as we can throughout our career, and I'm sure it's your goal too.
Today, we're sitting down with someone who is our age and has accumulated over 179 doors in recent years, and today, we're gonna learn all about how he did it.
All right, so like we said, we have a good friend of ours, a friendly competitor here in town. We've known him for a long time, Casey Ryan. He is a big wholesaler, huge cash buy and hold investor now. Thanks for coming on, man. We appreciate you being here.
Yeah, of course. Thanks for having me.
Yeah, it's really fun. You know, what's funny that I was thinking about was when we say friendly competitors, it used to be so close to home, but now we've collaborated so much with all of our friendly competitors in town where it's like, collaborating nowadays is making everyone so much more money than holding it close to home, you know, as people used to do. So it's funny, like we've done deals together and, you know, we've passed deals back and forth, and it's crazy how things have come to that nowadays.
Yeah, I always feel like the what you gain together always way outweighs. You may lose here and there, but at least you lost to a friend, whatever, and that's, I always like to see it to go to somebody that I know, but what you lose to each other is way less than what you gain together.
Yeah, I think we're finding that more and more just with, you know, guys like Ryan, and I know you work with a lot of guys as well that we know, and even guys in-house here that we work with. It's like passing the deals back and forth, or even the knowledge back and forth. You know, it's cool to learn from each other, and everyone's making so much more money that way.
Yep, I agree, absolutely. And everybody's got their own niche too, so it doesn't, you're not always conflicting. It's just kind of rare, and there's enough out there for everyone, especially now that Zillow's not buying, so.
Right, yeah. So let's talk about that. Yeah, so tell everyone a little where you started. I mean, you know, let's start on the wholesale side of things. You know, I think that you know, tell them about your degree, where you started, and how you kind of transitioned into real estate, because I think it's super interesting.
Yeah, so I went to school for 5 years at UNLV. I got my engineering and finance degree. And towards the tail end of that, I started, my previous partner, we started flipping houses, and I kind of, I had spent a few summers kind of interning with him, just figuring out, but I didn't want to just up it and abandon my degree after I was 3-4 years in. So I finished that through, and then as I graduated, I was taking job interviews, and little by little, I just realized that I didn't want to be an employee the rest of my life. So I jumped ship, burned the boats, rejected those job offers, and jumped into real estate. And
I mean, that's a pretty like academically intensive degree that you got with engineering, and you never use it. So what's your thoughts on that? You know, as college, what it used to be, do you need it anymore? What do you think?
I think that any type of engineering degree is just trains your mind to be a problem solver. And also it taught me a lot of discipline, because, you know, high school you can just coast through. As you get through college or into college and in the engineering field, it's not the case. Like, you have to be very dedicated and, you know, adhere to strict deadlines, and that taught me a lot about just getting things done. And whenever you're in engineering, there's always 7 different ways to come to the same solution. So it just taught you different ways to think. So I did take that from it, but as far as like the specific knowledge, not really. I mean, rarely do I ever use anything with that.
That's all right. We've noticed a lot of people that we've interviewed, and even mostly real estate investors, that have gone to college and have gotten a degree that's probably in something else, because I don't really know anywhere you can go and get a real estate investment degree. So they have that battle where, you know, I need to finish this. I feel obligated to kind of see it through, because I've invested so much time and effort and money into doing that. But the call to not work for someone else, the call to be your own boss, to create something on your own, is just so much louder and so much bigger that they eventually just have to kind of let it sit by the wayside. But that's something that is so common with so many people that we've brought in here, is that decision is just so clear.
Yeah, it actually, I mean, it wasn't clear at the time. It was scary to make that jump. I remember having the conversation with now my wife and saying like, hey, if we get in a tight situation, we're going to be relying, because she's a nurse, or she was, now she's home with her daughter, but I'm like, we may have to rely on your income. But luckily, well, actually there was a period of time I had a lot of savings just from over the years. I was a hardcore saver, but there was a period of time in the first 8 months or so where I had paid out more than I had made, because there's that sales cycle, especially when you're flipping. If you're wholesaling, it's a little bit quicker, but there's still that down period of the learning curve. Then when you get stuff under contract, it's still, weeks before or months.
Time.
Yeah, it takes time. Yeah. So and when you're flipping, you add another 120 days onto that cycle. So if it was like 8 months where I had paid out more and I hadn't brought anything in, but the pipeline was getting full. But
yeah, I think the interesting thing there is, as smart of guys you are and the degree you're going for, I mean, you still took a major leap of faith in your life and took a major risk to chase an opportunity that you really saw. And I think that's important for people to realize is it's okay to switch paths and take a leap of faith and chase what you think or know is going to be better for you in the future. So,
right. And it's never about year one. It's about year 5 and year 10 when you're set up for the rest of your life. And I do remember also that conversation with my wife was easy, but thinking that I had to tell my parents, like they wanted their, everybody wants their kid to have a successful, stable job, and I dreaded having that conversation after 5 years of this, be like, hey, I'm not going to do this. And they didn't even bat an eye, though. And now looking back, they're very proud of everything.
I'm sure they are.
Good. I'm glad. It's a big transition, because going from education, like getting your education in college, being an engineer, jumping in and interning for a flipper, your partner who's flipping homes, then kind of being introduced to the world of wholesaling. And obviously you've really doubled down on that, built a big business on that, but now where are you going? You're into buy and hold, you're into bigger, better things, right?
Yeah, because wholesaling and flipping, it's so transactional, and all the guys that I know that are wealthy they buy and hold a lot of properties, and they're not constantly in the grind every single day. And flipping and wholesaling, in my opinion, is a lot harder than buying and holding. But the tough part of buy and hold is the capital, obviously, especially if you're trying to do it quickly. But just moving forward, I don't want to be in that grind the rest of my life, so I don't think I'll ever stop flipping, but I don't know if I'll continue to do it. It's try to do more every single year. It's like we'll kind of just stay at this pace and continue to acquire rentals over time.
What's that pace? Just for those out here who don't know who you are and the amount of properties you do, what's your last 2 or 3 years look like consistently?
Because you casually say pace, but I don't think that they understand this.
Let's tell them,
I think going from year 1, I think we did about 75 flips, just strictly flips. And then we stayed around the 100 or so pace, maybe a little bit more. And then the last 3 years, in 2018, I think I focused more on wholesaling in 2018, so you can crank out more properties. You're not making quite as much as if you're flipping them, but I think 2018 was 140 or so, 145. Wow. And then 2019 was... 2018 was 115, and then 19 was 140 or so. Then 2019 was about 140, but that was becoming to be a more of a blend of some flips, maybe 15% of those were flips.
Okay.
And then 2020 was about 135, and that was more like 70% flips. And then this last year, we've just pretty much strictly been flipping, and then buying and holding. I think just single family, we've closed a little over 200 homes this year. That's with about 75 rentals, and then the rest for flips and wholesales. And then we also bought a 89-unit apartment complex.
Wow.
On top of the 200.
Those are some big numbers. It's a lot of houses, a lot of deals.
It's been a busy year.
I think you found what a lot of people we've brought in, us as well, have found, going from 2018, 2019 to then seeing what the market's done 2020, 21. You're saying I'm doing so many wholesales, about 15% flips in one of those earlier years.
Yeah.
And then transitioned over to we're flipping pretty much everything.
Right.
Is that just because of market conditions?
Well, when 2018 is when me and my partner split, so I was kind of starting from ground zero at that point. So I was just wholesaling to build back up my capital so that I
could then get back into
exactly. And I didn't take on any investors, so it was just all my own, mostly all my own. I flipped with my parents a little bit, and then one of my acquisition guy, we partner with a lot of flips as well. So that was 2018, and then 19 I would just flip as I could manage my cash flow, and then 2020 it's like every year as you flip, I mean, pretty much your cash is kind of doubling.
Sure.
So, and you can't just continue to do, I mean, you could continue to try to do double the amount of flips, but you kind of start
it doesn't
to buy
exactly work that way.
Yeah.
And you do got to kind of get capped out unless you start buying things that, you know, may not necessarily make sense, and you start playing the game of, look, I'll buy 250 of them and hope that I win more than I lose, and we'll see what happens. But like the hedge funds kind of do that more than the personal one-off investors. So obviously, you know, wholesaling and flipping has built up the cash flow for you to buy all these rental properties. I really want to dive into the rentals today, because that's something Jesse and I are trying to do and want to learn from you on.
Yeah.
Because you've done it super fast. So, you know, tell us how you got started, you know, where you're doing it mostly, whatever you can tell us, and how you're financing these deals.
Yeah, so pretty much, I mean, the money that you end up spending in taxes, you're better off just using that for, let's call it down payments. Even if you buy them cash and refi them out, the money that's left in that deal would have been gone to taxes anyways.
Right. And it hurts.
Yeah, and it hurts. Yeah, so a couple the last 2 years when I didn't have any property to depreciate to offset those taxes, I'm like, I had some pretty hefty tax bills. So then rolling into 2021, I think the where you can kind of pick, in a sense, like whether you want a cash flow market or appreciation market, and I think it's good to have a blend of both. But if you want to just buy safely and scale quickly, I think a cash flow market is better, because you're not, if things go vacant, or you're in an appreciation market, your cash flow over all of your expenses is going to be lower, so you don't have that same buffer, which is called your debt coverage ratio, your DSCR. So that buffer is lower. So if you're scaling quickly, I think the safer way to do it is in a cash flow market. Once you have that solid base of recurring cash flow, then maybe start buying in markets where your coverage isn't as good, but you're going to have the appreciation on the back end of it. So I've got most of the properties I have are in Oklahoma, and I picked Oklahoma because, well, one, you could pick any of those, Midwest states where those are all cash flow markets.
Okay.
But I think it's more important who, not where, as long as you're in one of the top, 30 metros in the U.S. So I met some guys in a mastermind I'm in, and they already had 200 properties. They had a lot of cash flow, but they didn't have a lot of cash. So they're like, this year, I think we just want to continue to do what we're doing and just sell you all the properties and just take assignment fees on them. And they help, or they manage all the construction. They do the property management for me too. So I never would have been able to scale that quickly if I didn't have the boots on the ground there, and they had their whole operation already set up. So I helped them getting their marketing dialed in more, so that they could provide more deals for us and them in the future. So, and
you were just taking them and keeping them.
Yeah.
Okay.
Yep. So that, and then they started coming across a lot of good commercial deals too. So we have a storage complex under contract. We just closed on a 89 unit apartment complex out there, and then all the single family I've just acquired with them, and we're just getting them all stabilized, and then getting long-term debt. I close them with bridge financing or cash, and then we just put long-term debt after that.
And so that long-term debt, where are you getting that from?
So it's not really like a open to the public. It's an institutional finance company, but it's a guy that had worked for Fannie and Freddie for 12 years in their risk management for a long time. He raised a bunch of capital and started the company, so now they're just trying to deploy it as fast as possible so they can securitize, which securitize is when they deploy all the cash and then they go back to like money markets, that shops, and then get it all reimbursed basically at really, really low rates. So
it's like a refinance for them.
For them, but they get it at like 2%.
Yeah.
So, and then they just arbitrage the difference. So whatever their interest rate is with me, that they just make what's in between.
Sure.
But the quicker they securitize, then they can really have a lending home type company after that. So.
Interesting. Okay, cool. Yeah, I wanted to at least like point out, like, you're not just going to Bank of America down the street and like getting financing on these things.
You got to find these special lenders, and through networking groups.
You're doing big scale.
Have you guys done any commercial financing on your rentals?
No, we
all like conventional.
We don't have enough to even do that yet.
Okay. We only have a couple single families.
Yeah, because they want to do them in chunks. Like they're not going to just do a one-off or two. No. They want to see
bundles,
15.
Right?
Yeah, bundles. So once they get stabilized, we just refi them out and
We're working on that first bundle. Right now.
We are, and we own all of ours here. So we own 4 now here. Mm-hmm. Some of them were Airbnbs that we turned into fully furnished rentals, so they're actually cash flowing about $1,500 a month.
That's huge.
So it's $1,000 to $1,500 a month each. We're not buying anything that doesn't cash flow at least $1,000 a month.
Wow.
But this is a higher price point market. I'm guessing the Midwest market is you're buying these things for a lot cheaper than the $200,000, $300,000, $400,000 we're buying them for. Right. What's your average buy price point?
My average cost basis, so purchase price and all the renovations is like 110.
Okay.
And they're on average worth like 140. So I'm into them for 110. They're worth 140. And the average rents on those is like 1350.
And what would you cash flow on that rent?
So your cash flow is definitely going to depend on the type of debt you get. Mm-hmm. So in the beginning, I could not find any lenders that would do 30-year AMs, like that would be able to do it smoothly. Like local credit unions, they'd only give you a 20-year AM, like the normal conventional mortgage that you have on your house.
It's too expensive.
You guys know it's a 30-year, but for your viewers, it's on a 20-year AM. Like if you got a 15-year mortgage, basically. The interest rates were higher too, like high 4s. Mm-hmm. And then they have a lot of points. But then as I went through it, I found the lending company, and then they started giving me 30. Well, also those 20-year AMs were only like 5-year fixed, which you'll see in a lot. If you want higher or longer term that the interest rate is fixed, then your interest, it's like give and take.
So after 5 years, you could adjust, and that could kill you too.
Right.
That could kill the deal completely.
Yeah, and you're just very exposed to market shifts.
Sure.
You know, so. I didn't want to take on any more debt that wasn't a 30-year AM, 30-year fixed, which is tough to find in the commercial space. So they do 30-year AM, 30-year fixed for me. I'm in the high 3s now, or like mid to high 3s for my interest rate. And the best part is that none of that debt on my portfolio financing, it's all non-recourse. So I don't have to personally guarantee any of it. So I'm protected. I know, it's like I've never had. Like,
where'd you pull this rabbit out of the hat? Like that's crazy.
I can connect you guys with them, but
thank you.
Yeah, they just do them in chunks. And so, but back to your initial question, that amortization period is going to really dictate your mortgage payment, which is going to dictate your cash flow. Mm-hmm. So when I was on 20-year AMs with some of them, my average cash flow is like 320 or 330, and then but now it's like 520, 515. So that's how big of a difference that interest rate and AM schedule makes.
I just had noticed like some other people that are investing in the Midwest, they're going for the $300-$400 mark.
Exactly.
Generally, that's what they're going for.
And on a standard long-term year lease, that's pretty typical. If you're doing unique stuff like Airbnbs or fully furnished or corporate rentals,
different.
All bets are off. Like you can make way better money.
But that difference in that little bit of profitability on the cash flow side, I mean, if the market does adjust, one thing that we've talked about with other investors is when they're buying these rentals, they really want to make sure that if there's a downward adjustment in the market, they're at least covered at that point. And at $300 a month, it's really tight. You know, if you're at $1,000 a month in rent and the market adjusts 20%, you're almost underwater on that deal and could be underwater on it. But the extra $150, $200 a month that money difference gets you, the financing change gets you, keeps you a lot safer on every deal. Which is
the more
crucial.
you have, the more diversified you are. So one vacancy on 10 properties isn't 10% vacancy anymore. It's like it's spread out between all of them. And then, not to mention when you're using debt to build it, you're all these properties that I'm into them for 110, they're worth 140. I'm built every property that I buy. I mean, it's obviously if I go to resell them, it's not quite this, but you're getting 30,000 equity on all of them. You're getting appreciation on that many properties versus if I bought them all cash, I would have a third of the properties or less. So I get appreciation on all of them, and I get the depreciation on all of them, which is what I wanted the cash flow. But really, what pushed me to do it was just the tax bills were. So the tax savings when you have more is better.
It's so important.
When you really begin, we're definitely going through it right now. When you begin to invest and you start to grow in your investment career, whether you're wholesaling, whether you're flipping, it seems like you have to have a realization that you have to have another business.
Yep.
You have to have a buy and hold, a rental business where you can offset that. Because if you just continue to run on one side, you're going to just be bleeding money.
Right.
You're literally handing 34% or give or take of your income over to the IRS for really no reason. I mean,
so if you
got to offset it.
Right. So if you got a business that makes $3 million, now you only have to make $2 million to really net the same amount.
Right.
So now, if just all that would just be going to taxes.
So just want people to understand that you may be interested in wholesaling and flipping, and that's what I have my mindset on doing, but you better be open to the other side of things.
Right.
And that's why we like to talk about the cash flow too, is I found this property and I can cash flow, it's positive $200. Well, be careful with that because you don't know what's going to happen longer term. You may want to insulate yourself a little bit more. You don't want to just take it for face value like that. Oh, it happens to be the first positive deal I saw. You want to make educated decisions, something that you want to hold these houses for a very long time. So do we. Yep. We don't want to have to give these up. We don't want to have to own a house that we're paying for, given some downturn or anything like that. So we want to make smart decisions on what we're getting in and be open to doing things the right way.
Yeah, and $200 is not enough coverage at all. And $200 could be different from like the way that I look at $200. I'm saying that's $200 after CapEx factored in, vacancies factored in, like that's
all your budgets aside.
Yeah, repairs and everything.
Exactly. That has everything built into it. So if you see a house that you're like, oh, my mortgage and insurance and taxes are going to be $1,000 and rent for $1,200, that's not $200.
No, not at all.
Close.
You're probably negative on that deal.
Exactly. Yeah.
So be careful on that because it's something that we've learned the hard way. Once with the Airbnb side of things. Luckily we got ourselves out of it. We bought an Airbnb that got shut down right away from the city, so that was a $2,500 payment that we had to figure out how to get away from. Luckily, the fully furnished rental pulled enough to cover that heavily.
That's great. Yeah.
Are you buying Airbnbs?
I'm not. I'm looking at some. I would buy more, but I gotta focus on. I can't do everything at once. You know? I don't have a huge team to just take all that on for me, but. As we grow and I get better people in place in construction and stuff, then I'll start focusing on doing some of that other stuff as well.
So we've gone a pretty good time here with our interview. I just want to ask one big question, what's your next big thing? What can we expect to see from Casey coming down soon?
I'm just going to continue to acquire rentals and get them stabilized, and then once I have more free time, I'll be able to explore other things. I know you guys are doing some education down the line. I'd like to do that too. I know some people on my team also want to explore that. We've been doing the flipping and wholesaling for a long time.
I think you have a lot to teach.
Absolutely.
Yeah, and it's a lot. It's very fulfilling too because I'll teach and help people all the time for free, but you can't help as many people when it's just these one-offs here and there. So down the line, I'd like to do that too. That's about it. I'll keep just cranking it out for the next few years. So really, I just want to buy back my time so that I can. I just had a daughter, so I want to be able to, these are the most crucial years of her life, so, and I want to have more kids. I want to be able to have that freedom to focus on my family.
What does the Casey Ryan legacy look like?
Oh man, I want to be able to have generational wealth for my family. I want to be able to retire my parents. Actually, I don't ever want to just hand my kids millions of dollars, so when I die, I'm not going to allow that. There's no good reason why someone should just be.
There's way better ways to structure that type
more
of
than
stuff.
it helps them.
Exactly, yeah. So, that's kind of it. I just want to be able to grow my kids and pour everything that I know into them and spend as much time with them to set that next generation off.
Not a bad plan.
Yeah.
Well, dude, we appreciate you coming out today.
Yeah,
it's always fun to learn from you. Once again, the power of networking, the collaboration side of things. Like you said, you'll link us up with your lender. That's what it's all about.
Yep.
So if you guys are watching, get into network groups. Casey got his guys in the Midwest out of a networking group. It's truly the way to build and expand your business. So thank you for coming on.
Yeah, of course.
Appreciate
Yeah,
it.
thanks for having
Thank you.
me.
Yeah.
We learned a lot. I hope you guys learned a lot. If you have any questions on anything we covered, drop a comment below. We'll get back to it. If we need to, we'll get Casey to answer it for you.
So until then,
We'll see you on the flip side.